we're going to talk about the taxable income, and also how do you calculate your income tax, and then how do you have the real cash flow diagrams. I mean, how do you calculate the cash flow after you consider the original price, the original cost, plus the depreciation deduction, plus the taxable income, and then how do you get the final cash flow after all these considerations. And when you are going to make a decision, you want to focus on the after-tax cash flow diagrams, because that is your real cash flow after all of this monetary adjustments. Okay, so first thing is about the taxable income. I think this might be a concept you're all familiar with, especially for someone who is familiar. For those who is familiar with the tax return process, so taxable income is if you're running a business, okay, you have your gross income, which is your the money you receive in your cashier every day, okay, or in your account every day, and that is called gross income. And the gross income needs to minus all expenses, right? Because if you're running a business, you need to operate that business, you need to rent a place, you need to hire some people, right? You need to buy equipment, you need to pay for the utilities, all those expenses. You need to take that from the gross income, except capital investments, okay? So your gross income minus all the expenses except capital investments. Capital investment is the lump sum you pay at the beginning of the business to let it run, okay? So that investment is not included in the taxable income, okay? And also you want to minus the depreciation deductions, okay? So that is how you calculate your taxable income, okay? So use this formula to calculate taxable income. And let's look at this example. So a company invested 100 million on an asset, okay? So because this is the initial investment, so it is capital investment, okay? Which generates 1,500,000 of gross income during its tax year. So this is what? Gross income, right? And incurs operating expenses of 800,000. So that is your expenses. So you want to know this is the capital investment, and this is your gross income, and this is your expenses. The total depreciation deduction for the tax year equals 114,000. This is what? This is your depreciation deduction. All right. So now what is the taxable income? So using this formula, your taxable income should be gross income, which is 1,500,000 minus your expenses except the capital investment. So expenses is 800,000, and also minus the depreciation deduction, which is 114,000. Okay, so based on this equation, your taxable income would be the result of this calculation. So let's see, what's that? $1,500,000 minus 800,000 minus 114,000, which is 586,000. So this is your taxable income. And whenever you know the tax rate, you can multiply this number by the tax rate, and then you will find your tax owed to IRS. Okay? So whenever you want to calculate your tax, you always want to know your taxable income. That's the base where you can calculate the tax. And another concept is about the tax rate. Okay, so there are many ways to calculate tax, different systems, and one system is called effective or marginal corporate income tax rate. It's marginal. Why? Because it is based on some, on how much you earn in your gross income, and the tax rate is only based on the additional amount of your gross income, okay, compared to some base number, and we call those base numbers bracket. Okay, so let's just take a look at what this tax rate system is. So first, under this marginal corporate income tax rate, the more you earn, the higher tax rate you pay. Okay, that's reasonable. But the higher tax rate only affects the additional amount. Okay, that's why it's called marginal, because it's only based on the additional amount. Well, additional to what? To these numbers. Okay, so read this table. This is corporate federal income tax rate in 2006. So this year, 2020, the numbers might be different, okay, but the concept and the structure is the same. So what is said in this table is how much you earn and how much you pay for the rate, for the tax, okay? So first, this half, it gives you some brackets, okay? And so it's like some windows or brackets where you can, fill your gross income in. So for the first row, that bracket is the amount you earn from 0 to 50,000. Okay, so that is the first bracket. So whenever you earn less than 50,000, your tax rate will be 15% of that gross income. Okay, but if you earn more than 50,000 but under 75,000, then you need to fill up these two brackets. So the first 50,000 you earn will multiply the 15% to have one part of your tax, okay? And whatever left of your gross income, in your gross income, remember that you earn more than 50,000, but the number is lower than 75, so there might be some left over when you take out the 50,000 to calculate for the first bracket, okay? So what is left needs to multiply the 25% rate. And that is the second part of your tax. And then you're gonna have the first part plus the second part, which is your total income tax. Okay, so let's check this example. This is exactly what I said. So you earn 74,000 a year maybe, and this number is bigger than 50,000, right? But lower than 75,000. So how do you calculate your income tax? First, you need to fill the 50,000 bracket. So the first 50,000, the tax rate is 15%, okay? So you need to use the 50,000 to time with 15%. And then whatever you have left in your in your gross income, which is 24,000. So 24,000 is what? Is 74,000 minus the first 5,000, right? So you have 24,000 left. And then those money needs to pay at the rate of 25%. Stop doing that. Okay, so this is how you calculate your income tax, and to simplify this system for you, okay, and I think we can think about this table as another table which you have different bracket to fill up with your gross income, okay, and then when you want to calculate your gross income tax, you just slice your taxable income into pieces and fill up that bracket table, which I will show you in the next slide, and apply a different tax rate to each of the tax brackets. So what you want to do is to slice your taxable income into pieces, and fill up the different tax bracket. Okay, now let's look at what type of table I'm talking about. So this is still the original tax rate table, and you want to translate that into something like this. So in this new green table, it is easy to use. So the original table actually is telling you that you have different brackets to fill up with your gross income depending on how much you earn, right? So taxable income bracket, the first column, from 0 to 50%. So that's the first 50,000. Excuse me. That's the first 50,000 you earn, right? And then for that part, your tax rate is 15%. And whatever left from 50,000 to 75,000, that part, you need to use the tax rate of 25%. Okay, then if you still have additional amount, then if that amount is between the 75,000 to the 100,000, then that amount left need to use the 34% to calculate the tax, and so on. So you need to first slice your income into different brackets and fill it up. Okay, so I know it's still very confusing. Then let's just take a look at this table, okay, at this example. So suppose that a firm for a tax year has a gross income of this number. So this is your gross income for that firm, and expenses is 2 million something, and depreciation deduction is 1 million something. So what would be its taxable income and the federal income tax for the tax year? Okay, so first you need to use that equation to calculate the taxable income. Remember that equation is what? Is to use the gross income which is 5,270,000. That's the gross income minus the expenses, excluding the capital investment. So this number is already excluding the capital investment. So you can just take it out from the gross income. So 2,927,500. And then minus the depreciation deduction for that tax year, which is 1,874,300. So this is gonna be your taxable income, and that will be 468,200. Okay, so this is your taxable income. And then to calculate the tax, you need to slice this into pieces to fill up this table. What do I mean? So first, the 468,000 is higher than 50,000, and it's also higher than 75,000. It's higher than 100,000. It's higher than 335,000, but it is under 10 million. Okay, so you want to slice your gross income and fill this table, but you understand, you know that you're gonna fill up this, but not this, because your total income is under 10 million. Okay, so first, for this 468,200, you have first, it is made of 50,000. That's the first 50,000, right? And then you still have another 25,000, okay, which is between the 50,000 to 75,000, okay, and then you still have another 25,000 in this total taxable income, and also you have another 235,000 left, and then after that you still have 133,200 left. Okay, so all these pieces, they sum up together, and you will have 468,200. Okay, so the sum of them will be the total gross income. Okay, so that's what I mean to slice the total income into pieces, and you always want to slice them into 50,000, 25,000, the third 25,000, and the fourth 235,000, and so on. Okay, and you fill this up, and then you're gonna use this tax rate to time the income to have your tax owed. So it's gonna be 15% times 50,000, which is 7,500. Okay, and then the second bracket, 25% times 25,000, which is 6,250. And the third bracket is to use the 34% times 25,000, which is 8,500. And the fourth bracket is to use 39% times 235,000, which is 91,650. And then the last bracket, you didn't fill it up, but you still have a part of it. That's fine. So it's 34% times 133,200, which is 45,288. So then your total tax you are owed to the IRS will be the sum of this. Okay, and that will be this 159,188. Okay, so this is how you use this system to calculate taxable income. To slice the taxable income, and then to determine for each bracket how much tax you owe, and then you sum them up.